Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the theory for Chapter 12, which is about financial statement analysis. And in this particular video, we are going to cover the from we're going to cover the vertical analysis and horizontal analysis, but it's going to be relatively short because there's not much to say about it. I'm not going to go over how to create income statements and the different accounts that should be used, so on and so forth. That's not the purpose. Um, what the purpose is, you have two different kinds of analysis, vertical and horizontal. So when you have your financial statement, you're either going to do it vertically, which is up and down, or you're going to do it horizontally, which is left and right, right? So with vertical analysis, um, realize that when you're analyzing, you can, well, let's imagine you don't see 2013 here, okay? This is all scribbled out, and all you have is 2014 information. Well, in and of itself, it doesn't mean anything. Well, I mean, it does, but um, it's better, you don't have anything to compare it to in order to be able to see um, whether that's good or bad, right? Like, for example, here, you have your gross profit, and it says your gross profit is 50%, but what does that mean? Is that good? Is that bad? Well, and compared to when you have something to compare one year with another, you can see that your gross profit is actually going down from the previous year, so that's not a good thing. All right, you obviously want a higher percentage for your gross profit. Um, yeah, you don't like the fact that it's gone down, but if you can justify looking at the reasons why it went down. Let's say, for example, the costs have gone up, um, well, and that causes your gross profit to go down. Well, then you can be proactive and increase the price of what you're selling the item for because your costs have gone up, right? That's what you're kind of like doing with this analysis. So vertical analysis, we're looking at things going up and down, all right? And basically it's in the form of a percentage. And what you're doing is you're kind of like saying, okay, um, as a percentage, like here, I'm going to start out with net sales. If I have net sales, I'm using that as the base. Remember, portion, base, and rate, if you go back to your math, right? If I use the net sales as my base, in this case here, $1,200 for 2014, then I can go and sit and say, okay, what percentage is my cost of goods sold as a percentage of my net sales, right? In this case here, cost of goods sold is 600, which means I have 50%. When the base is 1,000 for 2013, at 400 is my cost of goods sold, well, that percentage is 40%, okay? And that's all you're doing is you're taking a base, you're taking something that you're setting as your standard that you're measuring against, and you're working down through the math in order to get the percentages in a vertical fashion, an up and down fashion. Okay. Now let me go down to that was on an income statement. If we're looking at the balance sheet, we have the same thing. We're saying, okay, our total assets is 100%. Well, what percentage of that 100% is our cash, right? Well, if my total assets are 3,400 and I divide it by the 50, right, that ends up being 1.5% of my cash, for my cash, okay? And that's all you're doing is you're just creating these percentages in an up and down fashion, right? You're setting the base as your total assets are 100, and you're setting your liabilities and equity as 100%, okay? That's what you're using as a base, and then you're figuring out the various percentages for each one of those particular numbers. And you're doing it up and down. And this, again, allows you to compare apples with apples, okay? Um, Not only within a company from year to year, but from business to business. You don't compare, let's say this is Tucker Enterprises, but let's say I had Smith Construction, right? If all you have is just dollar amounts, that doesn't, you know, that doesn't help you in any way, shape, or form. Okay, and by converting everything to percentages, now when you do your analysis, because you're working from the same base of percentages, it's easier for you to be able to analyze the information. Like for example, you know, here our property, plant, and equipment is 88.2%, and that was 3,000 out of my $3,400. Well, if I had, you know, the construction company, let's say they had $5,600 and as their total assets, and they had the property, plant, and equipment say was $4,400, right? Well, what does that mean? It doesn't mean anything to me, all right? But when you divide the 4,400 divided by 5,600, you know, that ends up being 78.5%, okay? Now I can look and go and say, okay, the construction company has property, plant, and equipment of 78.5. You know, Tucker Enterprises has 88.2%. Now it makes a lot more sense. We know that, you know, Tucker Equipment has more in assets, physical assets as a percentage versus, you know, the construction company. So that's how you use it, all right? But you're creating it in a vertical fashion. Now, if we look at horizontal, okay, what we're looking at here is we're looking left and right. Okay, that's the way the information is presented. So, you know, here we still have the same information going up and down in dollar amounts from 2013 to 2014. But what we're looking at is we look across. We're going across this way. So the difference between 1,200 and 1,000 is $200. Okay, and if we take that as a percentage of, okay, that's $200, an increase or decrease. That's the difference, okay, between the two numbers. Now, what are you using as the base? Well, you're using the base as 2013 in order to see what the difference was for the entire year of 2014. So we're using 1,000 and we're dividing it by 200. We're taking 200 and dividing it by 1,000, which gives me my 20%. All right. So the way you're thinking about this is you're saying, okay, first, what's the difference between the two numbers? All right. 1,200 minus 1,000 is equal to 200. So that's my difference right here. Right. Now, since this 1,000 was what was the end of 2013, which is the beginning of 2014, all right? Since that's the beginning of 2014, we use that number as our base because we're thinking about the difference that occurred during the entire year of 2014. So we start out with $1,000 as the base, and our difference is 200, which gives us our percentage. And what you're doing is you're doing that right across the line here, you know, right across the statement here for each and every number. Notice that for my gross profit was 600, my gross profit was 600, I have a 0%. My gross profit stayed the same, okay? If I have the difference here between 600 and 400 is 200, well, 200 divided by 400 is 50%, right? That's how I get my 50%. So when you're doing this analysis, okay, you know, they call it horizontal analysis, but all you're doing is you're just really manually creating these numbers. There's nothing difficult about creating these numbers. You're not making any thinking decisions at this moment in time. You're not making any judgments. All you're doing is creating the analysis, creating the numbers in basically a lockstep fashion. Okay. If we go down to our balance sheet, we have the same exact thing. Here's our balance sheet with our 2014 figures and our 2013 figures, right? Notice I have $50 and 100. So I'm down $50. And when I take minus 50 divided by 100, I get a minus 50%. Okay. And that's all I'm doing. I'm going down line item by line item by line item in a horizontal fashion, creating the difference and then calculating the percentage, right? Now again, that doesn't, once you've created these numbers, right, this is a mechanical thing. It's a manual process. There's no more thinking to this at all right? But we're not doing the actual analysis. All we're doing is creating the information when we do this. But they call it analysis, whether it's vertical or horizontal analysis, because that's the format, okay? The format with which you're creating information to be able to do, the analysis, which we'll cover in the video for trend percentages, which is the next one. So, kind of like look at this as a step process. You start out by having the previous period's statements. You have this year's period statements. You decide whether you're going to do a vertical or you're going to do a horizontal analysis, right? You decide which one you want to do, and then you create, you create this information depending upon whichever format you decide you're going to use. And once you've created the format and you've filled in all of this information, that's going to lead us into the next video, which is on trend percentages. So I'm going to stop here, and like I said, we'll move on to the next video to actually see what we're doing when we're analyzing that particular information.